Good evening, everyone. Till now, we have covered a broad understanding of ESOPs as well as the key data, methodologies, and assumptions. Now, let's go through a practical example of how ESOP expenses are recognized over time. In this case, XYZ Limited, a private company, has granted ESOPs to its employees. Each of the 100 employees receives 10 stock options, making it a total of 1,000 options granted as on 1st April 2024. Now, these options have a 4-year vesting period with 25% vesting each year, which means employees earn their options gradually over time. Also, the option price is given to us as 100 rupees, which is calculated using the Black-Scholes formula after applying all the assumptions as Dribjot has explained earlier. So now, this gives us a total fair value of 1 lakh rupees, assuming that all the options granted will vest over the due course. Looking at the recognition schedule, now since, see, options don't vest all at once. So the company doesn't recognize the entire 1 lakh immediately. Instead, the cost is spread across 4 years based on a graded vesting approach, which means that a higher portion of expenses is recognized in the earlier years. Now, as we can see in this table, for tranche 1, since these options fully vest in year 1, 100% of this cost is recognized immediately. For tranche 2, this cost is spread for 2 years, with 50% being booked in year 1 and the remaining in year 2. For tranche 3 again, we can see that 33% of its cost is booked in year 1 and the remaining is spread out. And similarly for tranche. Since ESOP costs follow a front-loaded pattern, year 1 sees the highest charge to the income statement. Now, let's break this down step by step to see how the ESOP expenses recognized over time. At the top, we have the total number of options which are expected to vest, adding up to 1,000 options by the end of 4 years. We need to recognize the total fair value of options, which is 1,000 over the vesting period. Now, if we look at the chart below, which is commonly known as the waterfall chart, where we can see that we are not just booking the cost of what is vesting in that year, but also the proportionate expense of year 2, year 3, and year 4 as well. So, for supposedly for 1st April 2025, for the first vesting tranche, the entire 25,000 is recognized upfront. For the second tranche, we recognize half, which is 12,500. For the third, it is 1/3, and for the fourth, it is 1/4, giving us a total cumulative expense of 52,083 rupees. Now, coming down to 1st April 2026, again the same pattern will be followed. We again recognize 25,000 for the second tranche, 2/3 of the third, and half of the fourth, giving us a total of 79,167 in cumulative expense, with 27,083 recognized for the year. Again, for 2027 and 2028, the same pattern will be followed, wherein we book 14,583 for the third year and 6,250 in the fourth. However, one thing to note here is that this table assumes that all the options will vest as expected. But in reality, things differ. So, for example, employees may leave or which may reduce the number of options which are vesting, which would again lower the total expense. Similarly, if there is any modification to the ESOP scheme, say an extension of the vesting period or a change in the exercise price, the fair value and the expense calculations would need to be adjusted accordingly. So while this structured approach provides clarity, ESOP expense recognition is something that needs regular assessment to ensure it reflects the actual outcomes. Now, let's move on to the next slide, wherein we are covering the journal entries involved in the expense recognition. Every year, as we recognize the ESOP expense, we record it in the P&L account. At the same time, we create an ESOP outstanding account which sits on the liability side of the balance sheet. It is somewhere between share capital and reserves and surplus. This continues until the options are either exercised or get lapsed. So under the first scenario, if we look at the first scenario, since the options are exercised after vesting, employees pay the exercise price by paying 10,000 in the bank, which is nothing but 1,000 options multiplied by 10 rupees, which in our case is the exercise price. At the same time, we need to clear the ESOP outstanding account, which has 1 lakh sitting in it. So we debit this. Since the face value of each share is 5 rupees, we transfer 5,000 to equity share capital and the remaining 95,000 goes into share Dribjot. Okay, but what happens if instead of exercising, those options lapse after vesting? So in such a scenario, we can't reverse the expense through P&L. At this stage, it's just a shift within equity. So rather than impacting the income statement, the ESOP outstanding balance is transferred to another equity head, which is typically the general reserve. It's more of an internal movement rather than something that affects the profitability directly. Also, what if the options lapse before vesting? So now that's a completely different scenario because the options never actually vested. The expense we have already recognized needs to be reversed. And here's the key difference. Unlike vested lapsation, this reversal does go through P&L. That means the previously recorded ESOP expense is written back and the corresponding ESOP outstanding liability is reduced. This in turn reduces the overall expense in the financial statements. So depending on whether the options are exercised, lapse post-vesting or lapse pre-vesting, the accounting treatment changes. Understanding these journal entries is crucial because they directly impact both the P&L and the balance sheet. Okay. So now that we have covered the basics of ESOP expense recognition, let's talk about the other two key assumptions that can significantly impact the total charge to a company's P&L. With that is lapsation rate and performance achievement factors. First, talking about lapsation rate basically refers to the anticipated percentage of ESOPs expected to be forfeited or lapse before they vest. However, one point to note here is that since ESOPs are typically used as a retention tool, many companies assume a zero lapsation rate, especially for senior employees. However, when ESOPs are granted on a larger scale, attrition rate becomes a key factor. So as we can see here, a higher attrition rate leads to fewer options expected to get vested and hence a lower charge to P&L. Similarly, a lower attrition rate will lead to more options expected to vest and hence a higher charge to P&L. One thing again to note here is to keep the estimates accurate. Companies true up the actual number of employees at each valuation date instead of just relying on the initial projections. So that is very important point to note. Now, coming to performance achievement factors. See, performance achievement factors basically refers to the non-market linked vesting criteria tied to specific targets or milestones subject to a 1 year cliff like revenue, EBITDA, IPO, or a product launch. The probability of achieving these targets determines how much expense is going to be recognized. So again, higher probability of achievement will lead to a higher charge to P&L. Similarly, a lower probability of achievement will lead to a lower charge to P&L. It should be noted that this assumption is more of an input to the valuer and it primarily depends upon management's best estimate of when the targets will be met. Since these estimates evolve, adjustments are made at each valuation date to reflect the actual performance. In short, keeping these assumptions realistic and updated ensures smoother financial reporting and compliance with Ind AS 102. Okay. Um, Now that we have gone through the basics of ESOP expense recognition, let's talk about some situations where companies tweak their ESOP plans, like modifications, cancellations, repurchases, and replacements. These are fairly common, but they have very specific accounting treatments under Ind AS 102, and they can have a significant impact on the company's financials. Let's start with modifications. So, companies often modify ESOPs for various reasons. Sometimes to make them more attractive to employees, sometimes due to external factors like a change in market conditions. If the modification increases the fair value of the options, for example, by reducing the exercise price, the incremental fair value is recognized over the remaining vesting period. The original cost continues to be recognized as per the initial terms. Incremental fair value is simply the difference between the fair value of the modified ESOP and that of the original ESOP, both measured on the date of modification. On the other hand, if the modification is detrimental to employees, say increasing the exercise price or extending the vesting period, the company still cannot reverse the original ESOP cost. At best, it can avoid recognizing any additional cost. Okay. Now coming to cancellations. Companies sometimes decide to cancel ESOPs, whether due to a change in business strategy, financial constraints, or other reasons. The important thing to note is that from an accounting perspective, a cancellation is treated as accelerated vesting. This means that the company has to immediately recognize the full expense it would have otherwise recognized over the remaining vesting period. It doesn't matter whether the options were vested or unvested. Once the plan is cancelled, the cost has to be booked upfront. Upon cancellation, reversal of expense follows again the treatment of vested lapsed options, that is via general reserve. Next, coming to repurchase. So, many companies, especially startups and fast growing businesses, opt to buy back ESOPs from employees for cash instead of allowing them to convert to shares. This is typically done when companies want to offer liquidity to employees without diluting equity. So, from an accounting perspective, such transactions are generally treated as a repurchase of equity. The key principle here is if the company buys back the ESOPs at fair value, the excess amount is recognized. If the company buys back the ESOPs at fair value, then there will be no additional impact on P&L because it's just simply a reclassification within equity. But if the buyback price exceeds the fair value, the excess amount is recognized as an expense in the P&L. The logic behind this is that anything paid beyond fair value is considered as an additional compensation to the employee rather than just a share repurchase. And last is replacements. So sometimes companies cancel an existing ESOP plan and replace it with a new one, either because they want to update terms or offer a more attractive structure. In these cases, modification accounting applies. For the replacement ESOP to be considered a continuation of the original, the company must formally identify the new grant as a replacement on the date of issuance. When that happens, the incremental fair value is recognized over the remaining vesting period. However, if the company does not explicitly identify the new plan as a replacement, then both the cancelled and the new grants are accounted for separately. This means that the original ESOP is treated as a cancellation, requiring immediate recognition of any remaining expense, while the new ESOP that is granted will be considered as a fresh grant with its own fair value.